Welcome, everyone, and thank you for taking the time to join Cobalt Blue for this investor webinar. Today, you've got me as your host. My name is Joel Crane. I'm an Investor Relations Manager. I'm joined by CEO Joe Kaderavek and the Executive Manager Andrew Tong. The intention of today's webinar is quite simple. We really just wanted to provide a broad company update, as there's a lot going on. So we want to be able to provide this in greater detail and open it up for questions to you, our valued investors and followers. So with that, I'll hand over to you, Joe.
Yeah, thank you, Joel. And please take note of the disclaimer that's just been on the screen. Thank you, Joel, and good afternoon to everybody. I'm Joe Kaderavek, the CEO of the business. For those I've not met, good day. For all of you, welcome to the webinar. I'd like to start with what will probably be the central point of today's presentation on progress with respect to our Kwinana Cobalt Refinery project. We have for some time been giving the market guidance in terms of the strategic deliverables of the project. We've said that construction will be 2025. There'll be a validation process that'll take up 2026. Validation is effectively code for qualifying this refinery into a very high-spec chemical industry, and then full production in terms of revenue recognition for our production 2027. That guidance is still very much in place, and I'd like to reiterate that. In terms of near-term targets, we're now guiding for FID in first half, more appropriately in second quarter, but we are making some very, very strong progress in this development with respect to financing, approvals, offtake, feedstock, and other areas, which we'll touch on today. So all of the building blocks required for us to be in an investment decision and ultimately successfully beginning pre-development and construction are in place. In terms of what we've achieved in progress, we recently announced the appointment of our engineering partner at Tetra Tech. I'll let Andrew talk a little bit more on the technicals shortly, but that is progressing well with final reports due. We've published initial capital estimates and then final capital estimates, as in pre-construction estimates more recently, and we're very, very happy that they've very much aligned. Indeed, with those estimates plus a generous 15% contingency, and we'll talk about cost overrun later, but just a contingency on that construction estimate, we still hit the $60 million mark or so for pre-production capital. So we're very happy with that, and particularly with these fairly uncertain times with inflationary and other components, that's a really good outcome for us. We're continuing to test feedstock samples. So we're testing both domestic Australian product, but also international product. And as we've said to the Commonwealth Government and WA Government consistently, we are here effectively to be a gateway for Australian cobalt nickel feedstock into these global markets. There will be a time when these markets recover, particularly nickel, and there will be a time when more byproduct cobalt will be available for processing from typically a low-grade cons, which is currently being made into a high-spec battery specific sulfate product. So that future looks very, very bright for us. Operating permit applications are complete and said to be lodged, but I'll let Andrew again talk to some of the more technical detail as such. We're having some very robust discussions with offtake, and no doubt we'll have a few questions on the US election and its implications. But I think now that the uncertainty of the election is gone, I think there'll be a much more of a grounded series of expectations in terms of EV take-up, etc. And I think the overall message, irrespective of who's in the White House, is still very positive. And therefore, we expect a more stable investment space with respect to batteries and more broadly EVs. We are preparing samples as we speak. Again, Andrew will speak to that shortly. We're both actually at the Broken Hill Test Centre, Technology Centre at the moment. We are looking to make some very, very high-spec product, and our view is if we can make the high-spec product, then the broader market specification should be more readily easy to hit. And then financing is underway. I mentioned that pre-production capital number. Again, I stress that's 100% of the project number, and we do have a potential partner in Iwatani. We're looking to get into a binding relationship into next year. and that will take an equity portion of that away from us, and certainly will be a tremendous help in terms of us not only building the project, but ultimately marketing and operations. In terms of the economics, there's a lot to digest on this slide. This slide has previously been released by us on the ASX, but the key point here is this is a project that makes margin through the cycle. So this is not a levered play on nickel or cobalt, particularly cobalt metal. We don't need a high or long-term robust price for cobalt. This works through the cycle. So it's a matter of making a margin, even whether the cobalt price is where it is today, or double or triple that, and certainly double that being near its long-term numbers. So we're very happy that this will put operating cash flow on the table, as the numbers suggest, on stage one with a 3,000 tonne per annum metal equivalent sulfate refinery. Then we're going to be generating something in the order of north of 20 million EBITDA as a full project, and about 20%, 23% post-tax IR. So these are very robust numbers. If you look at it from a capital point of view, we're raising the equivalent of $20 million pre-tax every year. So that's like an organic raise. But the other thing it gives us, and this is a really important point to make, is it gives us commercial and technical connectivity with the market. It means that we have active commercial partners. It means that our process flow sheet and equipment work, and we're making the right spec. What that does is de-risk our Broken Hill Cobalt project when that comes in, and makes the transition to becoming a miner from merely a processor much more efficient. The blue sky on the refinery itself is effectively the stage 2 operation, which then doubles the underlying metal throughput. And because you've already incurred all the cost to set up the skeleton, which, by the way, stage 1 will be designed to retrofit easily as stage 2, then there's a much lower capital cost, just over 20 million Australian dollars to double that capacity, and then the returns get commensurately better. So we're getting an overall combined stage 1, stage 2 IR in the high 20s post-tax %, and an overall annual EBITDA on a 100% basis in north of $40 million. So it's a significant cash generator, particularly when you consider that 40 million Aussie EBITDA per annum is effectively, 1 year is effectively our market cap today. You can see the value proposition that the refinery represents for us as a business. With respect to remine, the refinery does actually give us one other advantage, which I should touch on. It means that ultimately we can process our own or third-party feedstock. So if we get into a position where a remine opportunity allows us to generate a cobalt intermediate or be part of a commercial transaction for a cobalt intermediate, that refining would stand there as a gateway for our own product. With respect to remine, there's a heck of a lot going on underneath the covers here, and we've had a very good year in terms of business development. In fact, our universe has expanded, and we're looking to communicate with the market ultimately with some commercial, or firstly technical and ultimately commercial stepping stones. I'm happy to say that we now are touching across 3 continents. We've previously announced a technical relationship with Hudbay Minerals with their Flin Flon tails. We are looking to transition, or via negotiation, from a technical into a more commercial relationship with them. And that's something that we're hoping to update the market in the near term. We announced earlier in the year an MOU of cooperation with Regeneration. Regeneration is effectively a recycling or circular economy business looking to create value and lower liabilities for ex-mining operations or mining operations globally, very similar to our own belief. And we're looking for opportunities with Regeneration. We're quite heavily involved in an acid project in northwest Queensland. Some of you may be aware that Queensland currently gets a lot of its sulphur credits for the sulphuric acid industry from one particular mine up there, which is shutting over the course of the next 5 years, and that would mean there'll be a deficit of sulphuric acid feedstock. So we're looking to, as a potential solution provider, to use our technology to basically recycle pyrite or sulfide tails and create acid. Of course, in that comes a very nice commercial upside with respect to any metals that are present in those sulfide ores. So you get a double bonus of creating sulfuric acid or feedstock for sulfuric acid that's desperately required, but also you get the metal commercialisation as well. We're currently involved in a Northwest Queensland tailings project, albeit just as test work sampling or technical cooperation, and we hope again to build that ultimately as something that we can present. And we've more recently, touching upon our new continental reach, if I may, begun a relationship with a Spanish tails business. So that's our first entry into the EU. We're going to be quite tight-lipped over any detail there because it's just a technical cooperation at this stage, but it represents for us a first beachhead, if you like, into the EU, because I do believe personally that the EU and North America present very strong opportunity sets for us with Remine because they have the oldest mines, and typically those old mines have very profitable metal byproducts in them because the technologies that created that waste weren't particularly efficient at extracting those metals.
Thanks, Joe, and thanks, Joel. I've got a couple of slides here just to provide a bit of an update on the Broken Hill Cobalt project and then a little bit more about our testing work out here at the Technology Centre. In terms of Broken Hill Cobalt project, listeners would realise that this project, we were working quite hard on a definitive feasibility study through the last couple of years, but earlier this year we decided to go into a strategic review. That was largely based on the high capital cost and low metal price at the start of this year. So now we're working through a smaller project to see if we can come up with a starter project with a lower capital cost hurdle to get into production. Obviously, in terms of metal price and where the market has gone this year, there's a lot of excess cobalt supply at the moment coming out of mines, and Joel will talk a little bit about the cobalt market. But in the short term, over the next year, 1 or 2 years, we don't really expect cobalt price to appreciate greatly, but it's still important that we continue holding this asset and looking to develop it in the future. It still is known or well known both in Australia but across the globe as a key primary source of cobalt if it can get into production because of the quantity of cobalt that's sitting out there out here in Broken Hill. In terms of some project work that we have been doing this year, we did contact the EPBC department in the federal government to look at a decision around our project. So we have been developing the permit side of it. So we asked them for a review of the project. They've come back and announced that the project doesn't have any particular issues or hurdles that require an approval under the EPBC Act. So that's a great stepping stone for us to continue with our permit work, noting that we don't have any issues under the EPBC. In terms of the rest of the work that we're doing on the project, a lot of it is engineering work at a smaller scale throughput. Previously, we were looking at a 5 to 7 million tonne ore project. So that's how much ore we'd be mining out of the project. We're now looking at a smaller case, probably around the 2 million to 3 million tonne mining project. Just turning a little bit to some of the work that we're doing here through 2024 in our testing centre. The context here is obviously developing the engineering work for the Kwinana refinery and also feeding all of the different conversations we're having around offtake. So I'll just step back and give you some context. Previously, we built this project out here, this pilot demonstration plant, to test the Broken Hill ore material. We did that successfully and processed nearly 6,000 tonne of ore through the concentrator, made concentrate, put a number of tonnes of concentrate through this plant. We did about 200 tonne of concentrate. In terms of what we've done this year, we went and sourced third-party materials that we wanted to put in our refinery. Principally, we wanted to build that refinery to take Broken Hill material, but with the Broken Hill project now in a strategic review, we then turned our attention to Australian feedstocks. Joe touched on this before, but the Australian nickel market has gone into a downturn at the moment. So we've stepped further afield and we're looking at material from offshore as well and importing that in. So this year's been about securing feedstocks to feed our refinery. And to do that, we've had to go and purchase material and test that. So that's really what we've been doing out here in the Technology Centre this year, is testing these third-party materials and processing them through to cobalt sulfate. The first half of the year was really focused on the engineering and feed handling type issues. So how to receive the material, how to get it into our leach circuit, how to break it down, how to extract out the cobalt, the nickel, and the other metals. So that's really what the first half of the year was on. The second half this year, it has been taking that leach liquor and optimizing all the purification steps. So removing out the zinc, the copper, the iron, the manganese, the calcium, the magnesium, and so on, and optimizing each unit operation to get there. So that's what we're doing at the moment. Right now, we're in the middle of a series of programs designed to meet one of our potential offtake parties and their specification. Once that work is completed, we'll then move to another group and work through their specifications. Every group's a little bit different, but it's just understanding how our process performs, looking at the different product specifications. Got a couple of photos there. Very, very recently, we have started looking at some of the battery recycling black mass. And obviously that's a bit of a small market in Australia, but it has great application overseas. When Cobalt Blue thinks about its strategy, the initial strategy is to get this refinery up and running in Australia. But we fully recognise that if we are to expand or grow and develop a second refinery, it's most likely going to be overseas somewhere. So it's really important to have a handle over other feedstocks. And if we turn to the EU for a moment, I don't know if listeners are aware, but the EU has brought in recycling mandates. So by 2031, you have to have a certain amount of cobalt recycled or sourced from recycling, a certain amount of nickel, a certain amount of lithium, and so on into the battery specifications. So we really need to be able to have a handle on what our process looks like taking recycled material. Just the last comment on this slide is just reiterating that our project stage 1 is 3,000 tonne cobalt, and then with a growth plan to go to 6,000 tonne. All of that growth plan really is driven by or related to the offtake interest. And offtake interest into this project is really firm around they need Australian product versus product from other countries. But there is uncertainty on volumes. And as Joe mentioned before, hopefully now that the US election has gone through, there'll be greater certainty in business decisions as people look forward to 2027 onwards in terms of timing it for our project. So really we're looking at business decisions around offtake from 2027 onwards, which really people are only now starting to firm up their business plans around that.
Thanks, Andrew. Before we get to questions and answers, I thought I'd just give a few words on what we're seeing in the cobalt market broadly, but more importantly, what we think we're going to see. I'm not going to spend a lot of time talking about the cobalt price. Similar to lithium, nickel, manganese, it's still suffering from oversupply, and prices are cyclical lows, and we're still waiting for the market to turn on that. But I thought we'd provide a little bit of analysis or talk about what we've been thinking about a lot, and that's really what the sort of markets we're going to be selling into. As we talked about a lot in terms of IRA, but not just IRA incentives, but also other punitive restrictions on importing material into the EU or into the US that come from foreign entities of concern, namely China. And that's why we put a few stats up like that. Currently, China produces 90% of the world's cobalt sulfate that's used in battery production. That's a very similar stat across a number of other critical minerals. So to combat that, as we know, the US and EU have put a number of taxes and tariffs, as well as incentives. So basically what we've done is we've taken all that data and aggregated into what we understand is actual material that qualifies for IRA or EU compliance. And it's a very small amount, as you can see by that chart, particularly versus the sort of demand that not only is in existence today, but coming. So this just serves as an important reminder of the market that we are entering, a market that we're going to be first entrants into, where there's, despite an oversupply of critical minerals such as lithium, nickel, and of course cobalt, there's actually a vast undersupply of compliant material. So that's why we're entering this market first. That's why we've spent all this time and effort on the refinery now, because that's the type of material that's required. The world, the prices of these commodities are telling you that the world has enough mines at the moment. What's really lacking is that midstream refinery output. So that's where we're seeking to enter. Okay, I think we'll stop there and we'll head to the Q&A session. We've got a few come through before and a few come through now. So thank you to those who submitted questions. I think before we really go into this more specific ones, we should probably address the most current market implication. That's what's happened in the U.S. election, of course, with the second Trump administration coming in. So what does that mean for not only Cobalt Blue, but the sector in general? I think I'll start with a few broad comments, then hand over to you, Joe, to speak specifically on the IRA. Give it that piece of legislation is what's influenced the markets over the past couple of years. I mean, look, now that Trump and it looks like his control of Congress come through, that means things can happen quite quickly. So we have to pay close attention to what he's saying and legislation that comes up and legislation that potentially could be turned around. What we do know about Trump is that he'll certainly be supportive of fossil fuel investment, likely to relax environmental restrictions. And what we do know is, based on what he said, that tariffs on imports are likely to go up and probably quite substantially versus even the previous Trump administration, of course, where they are today. And with taxes going up, the strategy is then to put domestic corporate taxes down, and that's really to incentivize reshoring of manufacturing. Now, that has very important implications for our sector, which Joe will touch on in terms of gigafactories in the U.S., but that's really what we're focused on and what we think is the most important implication. Before I hand over to you, Joe, just on commodities themselves, the near term, and that's what markets have told us overnight, is likely to be slightly negative just on overall commodity prices. And that's for a couple of reasons. Fears that there may be a global trade war that could damage industrial demand tends to put commodity prices on sort of a back foot or can serve as a headwind, as well as U.S. dollar strength, which tends to come in with new administrations. But actually, interesting for cobalt itself, lower copper and lower nickel prices are actually supportive of the cobalt market because, as you know, most of the world's cobalt comes as a byproduct of those two metals. So if the incentive for producing those metals reduces, then we get a faster than previously expected rebalance of the market, and the cycle could turn a bit quicker. So in summary, it's probably good news for the cobalt market. I'll stop there. Joe, hand over to you. Implications on Trump and the IRA.
Yeah, thank you, Joel. Look, my comments come from some fairly well-considered, views and relationships that we've had over the last 2 or 3 years. So just to give you some background, we as a management team travel to Washington. We deal with both the broader EV participants there, but also clearly the policymakers. So we've got some relationships there. So do bear in mind my comments reflect not just our view, but what we're seeing and what we're hearing. It's clear that the IRA is a decarbonisation market, and it's clear that's not particularly front and centre on this incoming administration's agenda. However, the vast majority of the investment, and on our numbers, and bear with me, these aren't precise, on what was initially a $70 billion stimulus package to 2032 for IRA, has drawn in about 140 to 150 billion USD versus investment. So it's been a very successful investment attraction fund, if you like, and the vast majority of that of those facilities are in Republican states. So you have an incoming administration that's banging the table on economic empowerment. It's banging the table on, as you said, reshoring manufacturing and making the US more significant in global manufacturing, and they've had a huge head start in terms of the previous administration's incentive to bring this on. So it's very unlikely in our view there'll be a repeal that'll imperil the existing investment program. It's acknowledged widely that the US automotive market has to generationally change or keep up with global trends, and those trends just happen to be electric. So we don't see threats to the existing investment, I'd say, because they are in line pretty much with the incoming administration's goals. And the incoming administration is very likely to use tariffs rather than incentives to effectively achieve that blossoming or reblossoming of US manufacturing and investment. So if you would ask me, what is the net effect? What would you prefer? Would you prefer an administration that creates incentives for investment, or an administration that creates tariff to create punitive outcomes for subsidised metals entities, if I can use that expression, or those countries or entities that don't play on a level playing field? I'm quite indifferent over the two. And the scope of the upside from either one is I think, quite commensurate. So let's see what the Republican administration comes in terms of its next 6 to 12 month agenda. As Joel said, we think there'll be some relatively rapid transition, but we don't think it'll imperil the investment that represents a major change in US manufacturing capability. That's the one area of commonality between both parties in the US.
Thanks. A question came in during that, sort of a follow-on that I think is important to address. How can Cobalt Blue compete with existing or planned U.S. cobalt and other critical minerals refineries, given that there's this direct U.S. support already announced? I might start with that and maybe hand over to either Andrew or Joe. If anything, I think compete's probably the wrong word to use. And if we consider them our compatriots or peers, and given that chart that I show, the huge gap of actual supply versus demand, all of those refineries being planned in the U.S. and the refinery being planned here are required. Yes, there is current support for U.S. investment domestically, but there's also support here in Australia for similar projects that will produce into that strategically aligned nation's supply chain. Joe or Andrew, either of you have comments on that?
We need to qualify the comments or focus the comments on the cobalt sulfate market, not broadly all the other investment or refineries. Within the cobalt sulfate market, as Joel mentioned, there's very limited production capacity right now in those countries outside of sort of a China focus. So there's definitely room for more people to get their projects up. But I also wanted to mention that while sometimes we look at the US building out these refineries and so on, they don't actually have the demand within their country to soak up all of the product. And so while we talk about building this project in Australia and being US and EU compliant, it's likely that our product will go to both markets. It's not just a one market monopolistic situation. So the refineries that are going to be built in the US for cobalt, yes, they'll have some lens to sell that within the US market, but most likely that product will be exported out of the US unless all of those steps get developed in the US. So we've got to remember, in the battery market, there's 10 steps from the mine through to the battery in the car. And at the moment, there's very limited countries that have all of those steps in one place. And so we need to be thinking about where the US is going to develop, where Australia is going to develop, where the other like-minded countries are going to develop. It's unlikely that you'll have steps 1 through to 10 in one country. Product's going to move between them all.
I think whilst there'll be an element of spot or near-term sales to our strategy, ultimately we're looking to build relationships, be they US or EU or even North Asian-based off-takers. So what we want to do is create a strategic long-term off-take arrangement. That means we can certainly create bespoke quantity, but more importantly, quality. So this is a very, very high-spec industry, and it is very difficult, and we've talked in the past about one-year qualifications, very difficult for new entities to come in and create off-takes because it requires that confidence. So what we want to do is create strategic relationships, be it EU or US, and as their specs change, because inevitably they do, the battery chemistries are evolving, our specs will change in real time. So it becomes a dependent relationship, less focused on cost. Cost is important, but more focused on quality and quantity and deliverables within those relationships. So just bear in mind, if the question has in it built in more of a spot market aspiration, whereas this is a strategic relationship business.
All right, we sort of addressed that big elephant in the room. let's drill down a bit more specifics. There's a number of questions on the refinery, so I'm going to pick on you for a few questions here, Andrew. Is Tetra Tech a large, well-known engineering company?
Yes. Yeah, they've got nearly 30,000 employees worldwide. So they're definitely a large company, but it's not really about the size of the company. It's more about who the principals are that are on our project. So who's the little sub-core team that we're working with? So we're working out of their Perth office. We've got a team of probably half a dozen to a dozen key people that we're working with on the project. In terms of the global market, they're more well known in the US and Canada, also in across Asia or into Europe. In Australia, listeners may be more familiar with coffee, which Tetra Tech purchased a few years ago. So that's kind of where some of the team have come from. But yes, they're a well-known, large, globally recognized engineering company.
Thanks. Yes, great partner to have. Andrew, the refinery, are you using any new technology that puts this development at risk?
That's a bit of a hard question to give a simple, succinct answer to. The answer is yes and no. So yes, we are using some new technology, but no, it's all been used in other places before. So when we think about that question, every project will have a different flow sheet. Every project has different feedstock. Every project has slightly different specifications and other variations. So our flow sheet is adapted from other well-known cobalt projects. In the cobalt space, there's been, for many, many years, people have made very high quality cobalt metal. In more recent times, people have moved into chemicals. Realistically, it's only been in the last decade or so that cobalt sulfate has taken off as a raw chemical material in large quantity demand. It's always been produced, but at large quantities, that's really only come in the last decade or so. So when we talk about new technology, yes, we are using things that have really only come to commercial proposition in the last 10 to 20 years. So it's reasonably newish, but all of those steps are well known. Ion exchange, solvent extraction, leaching, filtration, all of those things have been done for many, many years. So we're just adapting that for our process flow sheet.
Thanks. All right, final specific question to you, Andrew. How's the progress on customer specifications and the testing programs going?
Sure. So as I mentioned in the slide presentation before, we're currently deep into a program at the moment targeting one specific client. And so we've been working a little bit with them this year around what their specs are and what sort of sample quantities they need to be able to validate our testing program. I just want to draw a line though that this doesn't actually mean that we're qualified as a supplier to them long term. It just means that we've met their various hurdles to move into offtake contract discussions at appropriate for this point in the project. So FID or pre-construction, there's a level of offtake commitment that we're looking to obtain, but later we still have to go through the full validation and commercial sample quantities. So the difference there is at the moment we're looking at producing sub 1 kilo samples, but for validation we'll need to produce 1 ton, 20 ton, 50 ton lots that go out in shipping containers and so on, just to give the listener a sense of the quantity of material. So at the moment we're deep into programs where we're producing half kilo, 1 kilo, 2 kilo samples. We're doing that on a weekly basis here at the moment under very controlled conditions, specifically trying to remove some of those metals. I'm not going to go into which metals, but we're very close. We've just got 2 or 3 left that we're trying to reach their specification.
Great, thanks. Great progress at the Technology Development Center. Well done, Andrew. Joe, you touched on offtake. Just a more specific question. Are the offtake discussions taking place directly with OEMs, or are you doing it via Iwatani and their existing network?
Yeah, thank you, Joel. Look, that's a very broad question, and it's worth taking a moment just to paint a picture around that. So our relationship with Iwatani remains very strong, to the point where it's symbiotic in the sense of we are trying to help them with respect to addressing their issues and their customers and vice versa. So a question on offtake through Iwatani, I can't shed too much light on other than we're through Andrew and particularly the progress we made technically, we're trying to help them effectively with their decision making as well. On our side of the ledger, we're looking at relationships with a number of entities. So if you look at the broader market of who can buy your product, you start with trading houses globally. There's some very big trading houses who want to trade sulfates into these, particularly these Western markets as they grow. There are both battery industry participants, so that's everyone from precursor to cell manufacturing all the way within that chain. And then there's obviously the final automotive OEM, so the car maker. So in some cases, Joel, the car maker has what they call a directed buy, where they say we need to source 1,000 tonne, 2,000 tonne of cobalt as sulfate, and they'll direct their upstream to buy that from for example, from a Cobalt Blue for this specification. In other cases where the battery makers are large entities, and some of the North Asian entities are very large, they'll create that purchasing of their own right. So it's a combination of the battery makers as well as OEMs. What I can say is we've had some very positive and very successful relationships. And I do think now, since this noise of this US election is over, and just to reiterate a point, my personal view is it was actually negative run into the election. It was a worse outcome to have an unknown incumbent than either one of the potential incumbents that currently is. So the known node now is behind us, and we think that those relationships and those negotiations will pick up materially, particularly into Q1. So sorry, that's a long answer, but a combination of industry participants is who we're targeting.
Joel, can I just add to that? One of the things that we're all aware of when we read the newspapers is the big push in the last few years for domestic capacity or building out domestic manufacturing capacity. This is a US story, Australia story, the European story. Every country is looking at that sort of angle through their government policies. So when we talk about offtake, there's a very, very strong link between the potential offtake parties and their, I'll say local, but their local national government policies, if you know what I mean. So I won't go into too many details there, but if we call a hypothetical country A, when you go and talk to the car companies or the battery supply chain companies in country A, very, very close behind that is discussions with the various levels of government agencies and so on that are really keen to support the bilateral trade between Australia and whichever country that happens to be. That then feeds into the financing for this project, and there's very strong interest from various government agencies to look at how to support the project, underpinned by the company bilateral trade. So it's a multi-pronged discussion when we talk about offtake. It's actually offtake and finance, it's individual companies as well as government policy and agencies. So there's many angles to it, but we're seeing that there's very strong interest in supporting this Kwinana refinery from both Australian government agencies and foreign government agencies, but the actual details will be tied to the specific offtake agreements that we put in place.
Great, thank you. As usual, we have a number of questions on the outlook for the cobalt price. When is it going to recover? When are we going to see a more balanced supply and demand? Are the curtailments we've seen impacting the market? I'll just take a moment to answer that. Look, if you indulge me too, let's just go back a decade and a half or so. Really, this particular commodity cycle has its roots in the GFC. When we came out of that, the global response, the policy response was very low interest rates and massive stimulus. So what came out of that is large demand, particularly out of China, as we all know, for metals and other commodities at a time when investing in them and in new projects was quite attractive given the cost of capital. So as the years progressed beyond 2010, 2011, we moved really towards 2014 and 2015. We got this new exciting boom of of basically what we call now critical minerals. Back then was called new energy materials or battery raw materials, or this whole exciting story around EVs and rechargeable batteries. So around 2014, 2015, we got a huge CapEx boom driven by this exciting demand, but also by China with basically a central strategy of investing in building as much as they possibly can. They purchased a number of assets in Central Africa, in Indonesia, and other parts of the world, and developed everything as fast as they possibly could. We all know that in this sector, how long it takes to develop an operation, roughly 7 to 10 years. Well, that all started in 2014, 2015, and look where we are now. We're in a situation not only in cobalt, but of course lithium, nickel, and other metals where we've got a vast oversupply of mine supply that's pressured prices. But now when we look across the major producers, particularly when we're talking about cobalt, Glencore and CMOC, who are the major operators in the DRC, have both in their past announcements said they both see no new investments in copper cobalt output there. We know that Indonesia is growing, but much slower than before because of the bear cycle in nickel. So the answer to the question is there is essentially no new investment in cobalt, nickel, and even lithium mines at the moment. The focus is now at the position where we are midstream and waiting for, and you won't see any new investment in mines, particularly ours, until you see that recovery. So that was a long answer to a short, potentially a short, what could have been a shorter answer, but we are starting to see the cycle turn. We've seen a number of those cyclical turning points of a lot of mines either starting to cut capacity or just basically the CapEx slowing. So we do think the cycle is turning, and you will see a turnaround in prices. We expect really from next year. Thanks for indulging me there. Now, we're just about out of time. We had a number of questions just on our timeline of progression. So perhaps we'll spend the last minute or two just reminding the audience of what it looks like over the next couple of years.
In terms of Kwinana Refinery, this year it's been all about getting the detailed design completed, getting the permit submissions into the WA government, working on the joint venture arrangements with, getting that ready with potentially Iwatani, and working through some of the funding aspects for the project. So all of that's coming together. I know that it's always hard to be very definitive with a date on that, but all of that's progressing really well. We're aiming, as Joe said in his intro comments, to be able to do FID early next year. Whether that's in the first quarter or the second quarter is a little bit uncertain exactly when that'll happen, but we're very focused on trying to get to that point as quickly as possible. If that proceeds smoothly, as we're anticipating, in terms of all of these strands coming together, then we'd be looking to build the project through 25 and then moving into commissioning and validation in 26. Those are calendar years, and there's obviously some wriggle room around the firm dates for that. What that then means is that really commercial production, commercial offtake from 2027 onwards, and that hasn't really changed. We think we've got enough of a window between here and there to reach that. So that's our short-term focus. Longer term, as Joe mentioned, under Remine and under BHCP, there's a number of longer-term projects there. They're all moving along at various pace, but they're all very early stage. But you never quite know when one of those might suddenly move ahead very quickly, depending on what the opportunity set is.
Great, very clear. We'll wrap it up there. On behalf of Andrew and Joe, I'd like to thank you for joining us. In particular, our existing and long-term shareholders who stuck with us through this exciting ride. We're very excited about the future and looking forward to a very constructive, to use a pun, year next year. Thank you, everyone.